All right, let's dive right into this explainer. Today, we're putting on our equity analyst hats and doing a rigorous, fundamental teardown of Gogoro Inc. Now, if you follow EV and urban mobility, you've probably seen the headlines about their recent struggles. But, as analysts, we completely tune out that noise and look directly at the math. By the end of this, we're going to determine if Gogoro is just another dying hardware manufacturer or if it's actually a deeply discounted energy infrastructure play just hiding in plain sight.
Here's the exact mathematical framework we'll be using for our analysis today. We're going to cover 1. The target, 2. Absolute valuation models, 3. Sum of the parts, 4. Relative valuation, 5. Asset-based valuation, and 6. Our final intrinsic value. We are leaving absolutely no stone unturned here. Section 1. The target, Gogoro Inc. To really set the stage, we first have to understand Gogoro's massive strategic reset. Looking at our baseline metrics pulled straight from their full year 2025 filings, we see a company trading at roughly $4.17 a share. Following a 1-for-20 reverse stock split in late 2025, we have 14.77 million shares outstanding. That gives us a microcap valuation of just over $83 million. But here is the absolute standout figure, the thing you really need to pay attention to. Despite a really soft hardware market, their strict discipline generated an impressive $31.1 million in operating cash flow. Think about that for a second. That is a massive cash yield on an $83 million market cap. Now, a quick note on methodology. Because precise discount and long-term growth rates are missing from the actual corporate filings, we have to make some sensible external assumptions for our models. For a company of this size currently navigating a turnaround, we're applying a standard 10 to 12% weighted average cost of capital and a highly conservative 2 to 3% terminal growth rate that accurately reflects long-term inflation and standard GDP growth. Section 2. Absolute valuation models. Let's see how we bridge those raw baseline cash flows into a present value. For our discounted cash flow, or DCF model, we take that $31.1 million in operating cash flow and extrapolate it across an explicit 5 to 10-year forecast period. We are heavily factoring in management's own guidance here, specifically their target for non-IFRS profitability for the energy business by 2026. The bridge from reported financials to free cash flow is stabilizing really rapidly, especially since their major capital expenditures on battery upgrades officially wrapped up in 2025. By applying our WACC, we simply discount that forecast period and our terminal value right back to present day. And just for the sake of being incredibly thorough, I should mention the dividend discount model. But we are explicitly skipping it today. Capital is currently being retained to service debt and maintain their network. So without a declared, consistent payout policy in the corporate filings, we just can't reliably model future yields. Which brings us to the crucial anchor for our next calculation, $107.4 million. This represents the total equity, the book value, extracted straight from their 2025 balance sheet. It is the absolute anchor for understanding what this firm is fundamentally worth on paper. Because DCF inputs can be kind of noisy during a turnaround, we use that book value to run a highly robust residual income model by multiplying it against our cost of equity. But at the same time, we've also run an adjusted present value, or APV model. Why go through that trouble? Well, Gogoro's capital structure is shifting quite a bit right now, after they drew down a $68.3 million loan facility. The APV perfectly isolates the unlevered operational base from the present value of those new debt tax shields, giving us a much clearer picture of how their capital structure shifts impact total value. Moving right along to Section 3, sum of the parts. To get an accurate value here, we literally have to split the business right down the middle. And this brilliantly illustrates what is effectively a tale of two companies living under the Gogoro umbrella. On one side, you have a hardware vehicle division shrinking by 23.3%, bringing in $132.5 million. But on the other side, you have a battery swapping subscription service growing at 8.1%, bringing in $149 million. You see what happened there? Energy services have officially surpassed hardware as the primary revenue driver, and they boast massively improved gross margins too. By assigning lower, highly cyclical manufacturing multiples to that declining hardware side, and much higher utility-like infrastructure multiples to the growing battery network, our SOTP table isolates the true hidden value. Just look at the moat they've built, a 90% market share in Taiwan with incredibly high switching costs. Make no mistake, that is the real engine of this business. Section 4. Relative valuation models. Let's step back and see how Gogoro's pricing compares to the rest of the street. Since the official filings don't explicitly give us a comprehensive public peer group beyond just a few regional hardware rivals, We're making a necessary external assumption here. We've decided to evaluate them against broader business services and EV infrastructure peers, which we feel is much more reflective of their new energy-focused business model.
Guys, just look at these multiples. We are talking about a staggering 0.57 price to book and a price to sales ratio of 0.22. Now, their trailing PE is totally inapplicable because of current net losses, but their price to cash flow sits at an incredibly low 1.76. When you compare that to peer medians, this is deep distressed asset territory. The market is basically pricing this company as if it's heading for bankruptcy tomorrow and completely ignoring the massive cash-generating infrastructure they've built. Section 5. Asset-based valuation. This brings us to the ultimate safety net for any value investor, the raw physical assets. Think about it like this. What if we completely ignored future cash flows and just liquidated the company's hard assets tomorrow? They have over 2,700 Go stations and 1.4 million smart batteries actively deployed right now. What is the hard mathematical floor value of this business? We calculate that net asset value by restating the balance sheet liabilities against that $107.4 million in equity we identified a bit earlier. When we divide that total equity by our 14.77 million shares outstanding, that leaves us with a highly conservative implied net asset value of $7.27 per share. Compare that against their current May 2026 trading price of $4.17. Literally, the physical batteries and swapping stations are worth significantly more on paper than the stock market is currently valuing the entire company. It's wild. And finally, Section 6, Final Intrinsic Value. Let's pull all these threads together. This summary synthesizes the outputs of our DCF, residual income, APV, sum of the parts, and our asset-based models. It yields a really robust intrinsic value range that heavily factors in their recent operational success. Specifically, I'm talking about them narrowing their net loss by over $40 million and hitting a record $59.9 million in adjusted EBITDA for 2025. The math clearly shows a company successfully transitioning out of a high cash burn hardware cycle directly into utility-like infrastructure profitability. So, we have to end with this. With the company trading at a massive 43% discount to its book value, does the strategic pivot into utility infrastructure offer the margin of safety you're actually looking for? Is the market just completely missing the forest for the trees here, or is the turnaround risk still a bit too high for your blood? Take this data, run the math, and decide for your own portfolio.